Indermit, Richard, thank you both for joining us today. We have a series of interesting questions that we hope to address on the topic of emerging markets. So let's get going. Let's start with you, Indermit. The old normal saw low inflation and interest rates supported by globalization and rising productivity driven by technology. It seems like we're now in a period of transitions to a new normal. Do you agree? And how would you define that? And more specifically, how do you see the relationship with the US and China evolve? And specifically, if we are, in fact, decoupling or deglobalizing, what percent of the economic relationship between the US and China needs to be rebalanced or restructured, in your opinion?
So I don't know how to answer that question because it's a very difficult one, because I wish it were as easy as trying to figure out that, okay, we are in this transition to a new normal, right? That we're sort of leaving the old normal to the new one. But it's been very, very difficult to actually see things even as clearly as that, right? So let me start with some numbers, actually. So if we look at emerging markets and developing economies, if you look at a longer-term growth potential of these countries, you see that, in fact, it's not like there's been a sudden change in these things. In fact, if you look, there's been a steady decline in the potential growth of these countries over the last 20 years. Okay, it might have accelerated over the last 2 or 3 years, but there was a steady decrease. So, for example, if you look at the first decade of this century, the potential growth of emerging markets was around 6. If you look at the next decade after that, 2011 to 2020 or so, it was 5% growth, right? And then if you look forward from here on out, if you look at 2023 to 30, the growth rate is actually, the potential growth rate is less than 4, right? So the first thing that we get asked always is, well, isn't this all about China? And some of that is true. So a part of that is definitely the case. If you look at China, you actually sort of see the decrease in potential growth during these 3 decades. It goes from something like 8% or 9% almost to about 7% to now to about 5%, So 9, 7, 4.5, 5. So you do see that. Now, then if you look at India, you see that India's kind of steadied out. India stays at around 6% all the way through. If you look at Indonesia, Indonesia stays at around 5% pretty much all the way through, right? And then the next thing that you sort of see is you say, okay, let me take a look at other big emerging economies, right? And you essentially have you have non-Asian middle-income countries. So if you look at Brazil, if you look at Mexico, if you look at South Africa, much lower potential growth rates. And they've been relatively low in the past, and they've stayed relatively low all the way through. I mean, something like 2% potential growth, right? So their problem isn't that they've come down. Their problem is that they've been relatively low all the way through, right? So to answer your question, is that it definitely looks like a slower growth normal for emerging markets and developing economies. Now, within that, you're absolutely right. There are potential opportunities in a place like India or a place like Indonesia and so on. But I don't think that can be to the exclusion of China, because if you remember, I mean, China's GDP back when it was growing at around 8% a year was around 5 or so. China's GDP for the next decade or so is going to be more than 20. So in terms so even if the growth rate is halved, the GDP has actually quadrupled. So which means if you look at the absolute amounts, the additional amounts of economic output that China is contributing to the world economy, that will stay double that of that decade. Okay, it might even increase even more than that. So you can't sort of turn your back on China, right? So I think I've talked too long, and I'll try to answer the second part of your question along the way. Yep.
Thanks, Indermit. Richard, just giving you a chance to contribute to this question.
Well, as a stock picker, and we're very macro aware of conditions, but we really are driven by individual companies. And I've always felt throughout my 40 plus years of investing, it's very difficult to see at the company level the difference between 2% GDP and 5% GDP. It really is really dependent on the company and how they're executing. So that's the first thing I'd say. So the growth in Asia, the growth across Asia is still very good for us. And it'll contribute. As an example of that, our earnings over the next 3 to 5 years are expected to grow at about 13.4%, which is well in excess of what a nominal GDP growth rate would be. So I don't disagree with Indermit that we're going to see slower growth, but I don't think it's going to impact the outlook for equity investing in the region. That's much more going to be, particularly now, for a whole host of factors, it's going to be much more driven by individual stock picking, getting your money into the right places.
One issue that comes up time and time again is the demographic question, specifically with regards to China. So, normalizing for the fact that we should expect slower growth, albeit a bigger pie, as well as the idea that you can still find good businesses in China that are growing at healthy rates. How are you two thinking about the demographic question? Some of the statistics out there are pretty astonishing in terms of just the sheer drop in population. I think most of us are aware as to why this is happening, but I think a lot of people are still working through what this will ultimately mean. So I wonder, Indermit, how you think about it, and then, Richard, how you see that affecting the business models of some of the companies that you're investing in.
Okay, so again, I think it's worthwhile looking at some numbers on this one, Alberto. So I guess the first thing is to sort of look at, you can divvy up that growth decline, that potential growth decline that I mentioned to you into 3 components. You can look at labor, you can look at investment, and you can look at productivity, right? Mm-hmm. When I look at the China numbers, I actually would say that the part about demographics, if you're looking 10 years out or even 20 years out, is overblown, okay? Because if you look at the contribution of labor to growth in the case of China, it was pretty low, even back between 2000 and 2010, the additional amount of people. It almost went to zero. Actually, it went to zero in the last decade. So it's going to stay at zero now. It's not going to be negative. It's going to stay at zero, right, for the next decade or so. What's much more worrying about China, Alberto, is not the demographics. What's much more worrying is that you see a massive drop in productivity. So China, it appears, at least from these numbers, is that, of course, China's investment to GDP ratio will go down, and we think it's a good thing, right? But the thing is that the part that is not a good thing is that you see the share of productivity growth, or the actual size of productivity growth, actually dropping, pretty much in step with that decline, So it's not the labor part. It's a little bit more the investment part, but most importantly, it's the efficiency part. That's what worries us.
Wow, it's interesting. In our portfolio, we got about 20 to 22 holdings. About half of that's in China. We continue to see really good productivity coming out of our companies in China. We see an enormous amount of automation, almost kind of scary if you think about the unemployment rate for the young people in China, right? So we don't see it. But again, I don't have to be in every state-owned enterprise, and I don't have to be in every company. So it's not a surprise that I don't look at the world that way, Indermit. The other thing I'd say about the demographics that does concern me and has concerned me for a long time is real estate has been the asset of choice for Asians to invest in. They love the leverage. And generally what happens, they buy one apartment. As soon as they get some more cash, they buy a second apartment and a third apartment. And it looks like home ownership is really, really deep in China. But my guess is the home ownership's a lot shallower, but it's a lot of people have multiple apartments. And until they get out of those multiple apartments, it's very difficult for them to have an appetite to invest going forward. And we've seen this in 97, 98 first in Hong Kong. We saw it very clearly. So I think the tricky part for China is really managing their way through a need to stimulate and not stimulate property further. And so the way China stimulates is very interesting because it's not like the United States where we do the helicopter money. They're very specific, and they have the capability to be very specific in the allocation of their stimulus. But it needs to be. It's a tricky problem they face on real estate because it's about 25% of the economy.
Speaking,
I guess a two-hander on this one, Alberto. I think that China is very good at stimulus, or has been very good at stimulus. But it was always, Richard, it was always through the public investment channel and not through the private consumption channel, right? So, and I think that switch the country's having a hard time doing. And so, the drop that I mentioned, the drop in potential growth for China from, 8-9% down to 4-5%, it's a natural thing because China has grown really, really rapidly. It's gone from essentially a lower middle income country, the way that we put it, to almost a high income economy by our standards. But the problem is that if you sort of do this gradually, if there's a sort of a smooth transition from that high growth path to a low growth path, it's not a problem. But the problem really comes from if that becomes a little bit more choppy or it becomes much more sudden, that becomes a problem. Yeah.
I want to circle back to the issue of productivity for a moment because I thought that was a very interesting point. We've seen the headlines. We know that there's a race for AI supremacy going on particularly between the U.S. and China. Two ecosystems seem to be developing at the same time, increasingly based on different technologies and different approaches. One of the promises of AI that we hear about is the potential to act as a force multiplier for productivity. Is that how the Chinese are looking at it in your view? And is that how governments should be looking at it in your view? Setting it aside some of the other applications that we've heard about. It seems to be this promise on the issue of productivity here as well in the US. But I wonder how your research, both from the macro side, Indermit, and in terms of the conversations you're having with businesses, Richard, how they're using this technology to address some of that, or if they're not, if they don't really see a need for it.
But do you want to go first, Richard?
Well, that's a tough question. Okay. I think in Asia, to see it have an actual impact at companies, we're still very early. Even in our own operation, almost everybody at Overlook is using some form of machine learning and AI to make us more productive, and that's very clear. But we're sort of processing more data. Processing more data doesn't necessarily lead directly to having a better portfolio or better stock picks. So I think there are lots of advantages that AI gives, but when you look at a wider scale, we just have not seen enough to lead us to believe that the investments that are available to people like us are much more speculative at this point. And we're not good speculators on new technologies. We never have been. We'll let it go up and then come down. And then when the washout comes, that's generally when we get much more involved. So I'm sort of an imperfect person to answer the question. So we'll get something much better from Indermit.
Well, I'm going to try. So, here, Richard, so I did some work on this AI strategies in Europe, in America, and in China. And they have very different strategies towards AI. But the thing that struck me as you asked this question, Alberto, is that, if you look at the stage in which China is right now, so China basically has to go from, to actually put it a little bit crudely, right? You go from imitation to imitation to innovation, right? So some of the sectors that we are talking about are in that process of going from. Now, if you look at these two, they seem like a different step, but they're really not. Because when it comes to innovation, when it comes to imitation, a large part of this happens through foreign direct investment, trade, so you participate in these value chains and so on. It's largely quote unquote an inanimate process, in the sense that you can actually do this through large firms. You can do this, but as long as you're exporting a lot and as long as you're getting a lot of foreign direct investment and so on. That's the stage right now, by the way, that Vietnam is at. So Vietnam is actually in that stage of imitating, and I think they'll be doing a very good job of that. China has actually moved on to this other stage. And there you become a little bit more pessimistic now, because the fact that the first thing is that you actually find that there is this other part or other component of this cooperation, the US-China cooperation, which really was about inventions and patenting and so on. And our numbers, our trade group guys have been looking at this, and you find that since 2018, that the amount of patenting in these sort of joint industries and so on has dropped a lot in China and dropped a little in the US. So that's one worrying thing. The second worrying thing is that if you sort of look at the stage that you go into when you talk about innovation, it involves the movement of people. It involves the movement of people who bring ideas and innovations and so on from one country to another. Now, on that one, you're finding that at least our sort of anecdotal evidence, as well as a little bit more than that, indicates that that's not what's happening in China right now. So to put it very crudely, for example, you should start to sort of see New York and Shanghai streets look alike in terms of the sort of people who are walking around there. You should start to see Beijing and Washington look alike in terms of the sort of people who are. It's going in a different direction rather than coming together in the same direction. So that's the reason why I would sort of say, so I agree with Richard that actually at this stage it is highly speculative and perhaps a little bit on the pessimistic side.
Fair enough. Now, Richard, you don't just invest in China. Emerging Asia is a big region. I wonder if you can maybe talk a little bit about some of the opportunities that you're seeing outside of China, and more specifically, what you're hearing business leaders in places outside of China, in Asia, what you're hearing them say about what's happening in China and whether or not it's a net positive or a net negative for their business models. I'm particularly curious to know if there are any companies that perhaps sell their services or export their goods to both China and the US, or both China and the EU, or both China and the rest of Asia. And if you're finding that they increasingly have to essentially solve for two solutions rather than just one.
Yeah, the world got more complicated when the trade war started 6-7 years ago. The massive efficient machine that was Southern China initially and then Eastern China, all of that had to get restructured. And to us, that meant higher CapEx overseas, higher costs overseas, less efficiency overseas, and higher global inflation coming out of the deglobalization. And I think that we've seen. Okay, the next piece you have to go to as you look at companies today is you have to look for imbalances. Okay, the imbalances where you're going to have trouble. This is Buffett's comment: when the tide goes out, you're going to find out who's swimming naked. The guys swimming naked have imbalances. Now, I can point to one example. About 6 months ago, Apple Computer had 95% of their manufacturing in China. That's an imbalance, right? It even put the security risks of the United States at risk, or the security interests of the United States at risk. So and that's just one example of imbalances, right? And so you've got to get your supply chain restructured to really get in balance. And we see big efforts underway that are really like a decade-long process. If you look at Taiwan Semiconductor building plants around the world to get their physical presence more back in balance. And I think that, as an investor, you really got to be aware of it. So we talk a lot about that with our companies, and it's a complicated process. Not everybody can be a component manufacturer in China and then all of a sudden be a component manufacturer in 5 different countries while maintaining your investment in the R&D. So I think that's probably the single thing that we've really got to be focused on to not get caught swimming naked.
And as a quick follow-up to that, are you seeing a particular country sort of benefiting from this switch? Is it what everybody's talking about? Is it India? Is it Vietnam? Does it depend on the sector? I'm sure it does.
Well,
but yeah,
I think it really depends on the country, whether the country is willing to let these Chinese manufacturers into their country. For example, I think a lot of manufacturing from China has gone in and is being run by Chinese manufacturers that are now physically located in Vietnam or Malaysia. I think India, that's going to be a harder thing to do. But it really is going to depend on the business, because you will going to have some businesses that really don't play well in Vietnam. So, that's not your answer. It's a more complicated answer.
And much has been written about, the opportunity that India has to essentially be the top destination of reshoring activity. India has a history of being a fairly insular economy. It's never been known as an export powerhouse. How do you square that, Indermit, when you look at sort of growth projections for the country? Is it really more of a domestic story driven by domestic companies and domestic reforms? We're on the verge of a record third BJP administration. Or is it really this reshoring theme that, the press and other folks like to talk about?
So, so I think Richard is right. If you sort of look at most of the action right now, there has been some shifting to these 3 countries that came up. Essentially, Vietnam has done very well. Mexico has done, has taken some of that thing, and India has taken a little bit of it, including Apple, Richard, in the sense that you now actually have Apple iPhones being assembled in the south of India and so on. But that's relatively small. And then when you start to sort of look at it, you say, how restrictive is India's trade and FDI regime and so on. So I have these numbers over here. And the thing that struck me was, if you look at the first, I guess, the biggest restriction that these countries put is equity restrictions, in the sense that you can't own more than 50%, that kind of stuff, right? So India is about the worst there. I think the only country that does worse than India are the 3 Southeast Asian economies, Indonesia, Malaysia, and Thailand to some extent. But India does worse on this one than China does, just so you know. Vietnam does really well on that, and so does Mexico. That's not a problem in Mexico at all. Mexico and Vietnam both don't have very low restrictions compared to these other countries. So that's the one thing. I guess when you look at a big economy like India, you have to after a while, you have to disaggregate it into the states. Because just like China, you guys were saying that you first start in the south, then you go in the east, and so on. In India, it's sort of similar. Huh? You start in the south, then you go to the east, and then perhaps you go into the center. Now, if I had to sort of, I guess, a broad brush thing outside of things like FDI restrictions, I would sort of say that on the other things, the states have not picked up the speed. I mean, I sense that. So I go to India. I sense an urgency in New Delhi about these things. Then I go to the states and I don't really see an urgency, maybe except one or two states. So that's what we perhaps need to look for. That's what private investors will probably look for, is a good coincidence of central government reforms and a state government reform.
Fair enough. And Richard, how do you see, from a valuation standpoint, much of the feedback we're getting is that India is expensive, just given the run that stock market has had. Having said that, how do are you parsing through some of the opportunities there? Do you believe in a re-rating story? How are you defining, valuations in a market like India?
Yeah, I mean, we're not investing in India. About 2 decades ago, I decided that I was going to invest in China, and I took on an economy with 1.3 billion people at the time. And then India came on. I said, what, I got to do another 1.3 billion people? It's just, there was a limit to what my small brain could manage. India's done extremely well. China's done extremely poorly. My natural inclination is always as just an eyes open contrarian. We're more interested in China.
So circling back on that point, Richard.
So I do want to add something to what Richard just said. If you look, so I was looking at the private investment numbers for India, right? And private and public investment numbers. And what struck me, Alberto, is that this is a weakness in India over the last 15 years or so. So if you sort of look, India's public investment actually peaked back in the 90s, right? At around 10, 12%. It's now down to 6, 7, 8%. If you look at private investment numbers, India's private investment to GDP shares peaked back in the early 2000s. Okay, at around 28% or something like that. They're now down below 20%.
Yeah.
So these numbers back up the story that Richard is talking about, in the sense that you actually see private investment rather soft in the case of India, or softening at least, right? And then you start to say, what is it that you think? I think one of the things definitely is that I guess if you abstract from foreign direct investment, and for that, I think that you definitely look at things like FDI restrictions and so on, right? But for domestic investors, the thing that you look for is the cost of finance and things like that. And the Indian government debt has not gone up very rapidly, but it's gone up noticeably. Every time it goes up, it doesn't come down. It settles at that level, then it goes up again and goes up again. It's now up near 90% of GDP. It's long-term, it's at decent rates and so on, and it's all domestic, it's not in foreign currencies. So there's no risk of a debt crisis, but there is some pressure in terms of to the extent that you're a private investor, you feel crowded out, So both on the FDI side, where really you have this question about walls, and then you've got this push from essentially a bigger and bigger government in terms of borrowing, right? Yeah. And so you're getting pushed out there. So those are the complementary kind of investments that people like Richard would look for, and India is weak on that.
Makes sense. Richard, you know that we are, as an asset class, emerging markets are sitting on record low foreign ownership levels. You're seeing credit spreads at record highs. major outflows in both fixed income and equity capital markets broadly from emerging and frontier markets. And yet, this is a part of the global economy where we're seeing inflation come down pretty steadily, where we're seeing central banks begin to cut and ease well ahead of the Fed, just like they were well ahead of the Fed in hiking. And you're seeing, fairly healthy levels of domestic interest. I'm speaking in broad terms. What do you think will be the catalyst for the foreign buyer, the foreign institutional buyer, to re-enter the asset class, including China? What do we need to see in order for that to happen?
Well, we need to see better relations between the U.S. and China and sending that message out to the whole world. That's the simplest one to do. They're at least now talking. But I'm not overly optimistic about foreign capital coming into Asia and driving share prices higher, particularly in China. These are going to be domestic events. We see how the foreigners just leave Hong Kong every single day in selling stocks down. And that is probably a long way. I mean, they put a lot of energy into getting out. So it's a long way from coming back immediately. The average American institutional investor still has about 2/3 of their exposure into private and venture capital, illiquid securities in places like China. And they can't get any liquidity out of that. So they're just selling the public equities. And public equities are just, we're just completing a 3-year bear market. Valuations on our portfolio have gone from 23 times earnings to down to 14.6 times earnings. And we could put together an easy portfolio of single-digit PEs, but that's not where you want to be. You want to be in these great companies that are growing, have high profitability. I'd be interested to see what Indermit says about this, because I think the average American institution that I talk to is still closer to selling out rather than coming back in, with exceptions. And that's just a cycle.
Yeah, no, absolutely. Thank you, Richard. And in fact, Indermit, I mean, assume for a moment that there is some kind of recession next year, particularly here and in other developed markets. How do you think EM will react in a scenario like that? I mean, it seems to me, because we are at record low foreign ownership levels, and because inflation is actually moderating in many of these economies, that EM is fairly well placed to weather through a recession, a global recession. But what are your views? Do you think that historical correlations will hold?
Yeah. So there was a question that you had asked earlier to Alberto about fragmentation, trade fragmentation between the US and China. So that's something that is real. And one of the things that we tell our countries is that they should not. So in the past, you had the US, China hub, essentially, and then a smaller economy, whether it was Indonesia or even whether it was India and so on, would become a spoke, right, to that hub. So what we are advising our countries now is that we are saying, look, don't pick between China and the US. So you should actually, you should become the hub, even if you're a smaller hub. And then you have two spokes. You have one spoke is the US, the other spoke is China. And a lot of the countries, especially in Asia, are actually taking that seriously and saying, even though I'm a small hub, I'm going to join trade agreements that have the US as a partner and another trade agreement that has China as a partner. I'm not going to pick between them, right? And that strategy would work reasonably well. Then the other thing, of course, that they're worried about is what happens if there's some product that you're exporting and there's a retaliatory tariff or something. Should you also try to sort of protect some of your things? And basically what we're sort of So I think that what we're advising them is that, to the extent that you have to for political reasons and so on. So first is actually, the first thing that we say is actually for a developing country, it is better to be unilaterally more open than to engage in this stuff, right? From an economic point of view. But from a political point of view, sometimes you have to do it. And the advice that is to have sort of high walls, but a very small area that you're trying to keep walled off,
Yeah.
So pick these very, very thick. Now, then the question, of course, is this whole thing about decoupling between the US and China. The assessment of our folks is I guess, far more refined, because you can actually look at three types of products. There are first types of products which are of military importance. And you will see a decoupling there, and you have to just sort of see that as reality. The second part is where there is this problem of overly dependent on one country for the supply chains and so on. You won't see a decoupling. You'll see an attempt to have other partners, whether it's Mexico or India and others or not. It's not like you would decouple completely from China, right? And then there's a third group where you see that actually China now is beginning to have other competitors and so on. You won't see any decoupling there at all, or to the extent that even if there's a decrease in those relationships, it's going to be very, very gradual. So I think, at least from a trade point of view, I think the real problem is that the world is going through this adjustment, and perhaps that's the reason why trade has not been growing nearly as much as it should. In fact, trade growth during this recovery, has been the slowest in the last 5 decades in terms of recovery. 5 decades, okay? So it's very, very slow. But we are thinking that it's because countries are sorting into these sort of, both in terms of who you're trading with, etc., and then what are the goods you're trading on, right? So it's not like the global value chains will go away, etc. That's not going to happen. At least that's what we think. So then the question about recession. I think that I would actually push back a little bit on you. I actually would pretty much rule out a recession in the United States for next year. But by that I mean, will GDP growth drop below 1%? That's what we call a recession, right? I really don't see it happening. Who knows, right? I see that happening in Europe. Europe is skirting close to a recession pretty much all the time now, So I do see that happening there. And then you sort of say, okay, so what does this mean for the rest of the world? Well, in the past, we always had China kind of motoring on, And there's a little bit of a worry there now that China won't be motoring on nearly as much as it did before. So then we thought, okay, maybe what one can do is you can play a little bit of Moneyball here, and you can replace China with a group of smaller economies that do a little better, that basically get on base, right? So then you start to do that math, and that math is pretty depressing, Alberto, because if you take something like, if you try to sort of see how much does China import in a year, and you see how many countries does it take to replace a China in terms of the size of imports? It's about 3 trillion in the case of China. You have to go to India, Indonesia, Vietnam, Brazil, Mexico, South Africa, and then you finally get there. You get to the same 3 trillion. So we are a long way off from, actually decoupling, quote unquote, from China. It's not going to happen in the next decade. So I think, given all of that stuff, I think in general, people in the United States, people in the rest of the world should be wishing good things for China, not bad things.
Yeah. On just a quick add-on to this as you were speaking. So what does this mean for China's role as a traditional source of disinflation for the global economy? Should we sort of set that aside, or can China at some point return to play that central role, even with some of these trade relationships that are shifting and some, some of the decoupling that's happening in certain areas of the global economy?
So, I don't see inflation as a trade thing. I don't see it as the price of goods thing. I see it as a monetary and fiscal thing. So, like, for example, I would sort of say you just have to, take a look at countries that have a lot of domestic debt, right? Or take a look at, as soon as they get into trouble, even a little bit of trouble in paying that debt because interest rates rise and so on, there's a temptation for them to print money. And they end up getting very high inflation. So if you look, for example, at Argentina, there's a reason why it has 140% inflation. It's because it had to service $70 billion worth of debt last year and another $50 billion worth of debt this year. So they're going to print money, So I think it comes much more from that. And I think, to the extent that, yeah, maybe there was a little bit of a safety valve in the sense that China kept its prices low and so on. I think that was just a minor thing. I think that all of these countries ought to just get real again and realize that you will get inflation if you print too much money.
Yeah.
And you will print too much money if you run huge deficits.
And to that, when you look at the macroeconomic numbers across the areas where we invest, they're all in very good shape. We've been running current account surpluses since 97, 98. We don't have excessive government deficits. We don't have the inflation cycle that hit the US. We've got a lot of foreign exchange reserves. And so, there aren't a lot of red lights in our matrix of macroeconomics numbers that we follow that are saying, Richard, you got to get out of this country or you got to get out of that country. And so it goes back to it. I never know when markets turn, right? But I know that when markets do good things, companies are growing. If you can put together a portfolio that's growing at 13% with a 46% operating return, with no debt, supported by an economy that's cash flow positive with current account surpluses, eventually we have our day. And that's been the case over the last 32 years, where we've gone through all kinds of crises of inflation, deflation, banks going bust, et cetera, et cetera. So it makes my job much easier than Indermit's job. Absolutely, for sure.
Actually, in many ways, Richard, in these really tough economies like China, you say, what is the solution to China's sort of slowing growth rate, or actually worse than that, growing inefficiency, for example, right? It's to go back to what is it that led China's big spurt between 1990s and 2000s and so on? It was a move to market. So basically, you had essentially more than 90% of goods and services now in China are intermediated through markets. Now, those are products. Now, if you look at inputs, you look at land, you look at capital, and you look at labor, a massive amount of government intervention. I mean, these are intermediated largely through government rather than through markets. So the solution is actually in plain sight. You just have to liberalize those markets. You have to start to sort of intermediate those, and then you'll actually get much more efficiency, and you'll get another wave of growth.
The trouble has been, starting with Trump, we brought out the worst in the Chinese, and Xi brought out the worst in the Americans. And that overriding political security issue overwhelmed the reform agenda. And I think what we're seeing now in the last 4 months is many more Chinese officials are out and about talking and promoting China as a place to invest. So I think we're moving in the right direction. But as you can see with things like balloons, it's fragile until we get further down the road in having real private and confidential discussions at the highest level on real issues of importance. Coming out of APEC meeting in San Francisco, we agreed on fentanyl, and we agreed on the military should be able to talk to each other. Those aren't great achievements in terms of moving towards market reform. So now there's other things on their agenda, but it's going to take a lot of work. And with 2 wars going on and other things going on and an election, it's really hard to make progress on that. I tell everybody I know that what China and the US has to do is they have to go rent a big hotel in Yellowknife and put 3 people from China and 3 people from the US up there and start calling in experts and knocking off agreements and building trust. And with that, then you'll move much easier back to the reform agenda, Indermit, that you're talking about.
Yeah. And so, Richard, if you were a CIO or a trustee at an endowment or at a foundation in the US, and you're looking at China as a market, and setting aside everything that we just talked about in terms of some of the macro risks, the geopolitical risks, and you recognize that there's potential value there and that there are good companies potentially to uncover. However, you're also aware that Beijing has made it clear that no one company and no one sector will be allowed to grow too quickly or become too big or have too much of an outsized influence. How would you assuage their concerns about a government stepping in and saying, you can't be larger than X and you can't grow at a rate more than Y and you can't have more of a percentage of the market place? How should someone look at that, and how would you sort of counter that?
Well, I think our portfolio, the largest risk every single year is regulatory risk of something like what you're talking about happening. In fact, in an average year, it happens in about 2 out of our 22 holdings. So it doesn't happen everywhere, although theoretically it could. Okay. So then with regard to specifically to China, I mean, we're just trying to find sensible people doing sensible things. It's, when you're building the largest renewable energy company in the world that sells the cheapest electricity in China, they generally leave you alone. When you're making noodles and selling milk or selling medical consumables, running a casino, most of the time you're largely left to your own devices. So it's a matter of picking and choosing and trying to stay away from these hypersensitive areas where the government feels threatened.
Great. Well, gentlemen, we're coming up on our time. Thank you both for being so generous with your time and sharing your insights. We look forward to doing this again, and I wish you both a very happy holiday season and a prosperous 2024.
Thank you. Same to you.
Thank you, Alberto. Thank you, Richard.